Hello, everyone, and welcome back to Top Agent Nation Commercial Wednesdays. This is exciting. Lots of changes. As everyone knows, we were so happy to get 2024 behind us, especially for those that have been around longer, from COVID to interest rates to the election. And that was the big one. I think a lot of things we needed to have certainty of the election. And now in 2025, well, let's kick off with a really big bang to really know what happened from before to where we are now. And I know today there was a lot of different economic reports. Boy, and I'm really excited to have Nick here with us from Moody's as one of the economists to really share everything that is going on. And boy, I feel like a roller coaster, Nick. I feel like a yo-yo, a seesaw. I don't know, from ups and down is up because of what is going on. And really, what is the Fed looking at? And how can we position this year? As we know, there was a lot of pent-up demand, but still economic numbers will drive the rates and other things that I know for real estate and commercial real estate, it's a direct function of what we can do. So Nick, the show is yours, and thank you so much, and Moody's, for presenting this update for all of us.
Awesome. Thanks for having me. I'll go ahead and start sharing my screen right off the bat. All right. I'm assuming everyone can see all right. If I don't hear otherwise, okay, cool. Well, thanks for having me. It's really great to be speaking with all of you today. My name is Nick Luettke. I'm an economist at Moody's, where I've worked for a little over 2 years in commercial real estate. Prior to that, I earned a master's degree at the University of Hamburg in politics, economics, and philosophy. I then moved to DC, where I currently live, and earned a master's in international relations with a focus on international political economy from the George Washington University. Primarily, I cover 3 topics, and we're going to cover a lot of different topics today, but I think you'll see a theme of 3 of them in particular. All things housing, so multifamily, affordable, and senior for Moody's. Office, particularly on the space performance side, and struggle in the office sector, which is well known now. And then finally, policy. So government policies which could impact the real estate industry. So with that, I'll go ahead and get started. I want to start with a little bit on macroeconomy before getting into either policy or some sector breakdowns. I think it's helpful to kind of, as Jim was mentioning, start off by kind of level setting. There's been so much ups and downs over recent years that looking at the overall picture of the economy is really helpful. I'm going to start with what I see as the most critical aspect of the U.S. economy in its current state, the reason it's been able to weather the storm of the pandemic, of the inflationary period, and that's the labor market. We have a robust and strong labor market in America. If you take a look at the top line, green line, that is our labor force participation for prime age adults, so 25 to 54. It remains really high at 85%. You can see that there was a dip in the long run after 2008. Some people exited the workforce, no longer looking for employment, but we're at a really healthy level right now. The blue and orange lines are inverse of one another, as they are the number of unemployed people reported in the millions. And then the blue line is job opening. So many of you probably saw last Friday, the jobs report for December came out with a really healthy 256,000 jobs added in the month of December. It surprised a lot of people, and we'll get to rate cuts in a moment, but really discouraged the prospect of rate cuts in the year ahead. But that's funny to say, because at the same time, it is good news that the labor market is strong. Pretty much every aspect of real estate relies on a strong labor market. Sector by sector, the influences are different, but things remain quite healthy at 4.1% unemployment. On top of that, annualized wage growth in the month of December was 3.9%. So we see wage growth also remaining really healthy and really steady. One of the biggest changes you can see in the last couple of years compared to 2008 in the crisis was a long and slow recovery for employment, right? That is why, despite the recession not lasting necessarily the longest, the recovery was long and painful for many Americans who were still looking for work. Whereas the response to COVID and the uncertainty sparked there was much more aggressive. It helped influence the inflationary period. Of course, there were a lot of geopolitical reasons as well. But the flip side of that is that we haven't had the same struggles in the employment sector. In fact, the opposite was true in 21 and 22. 2022, excuse me, where the labor market was really hot. And so I think it's important to level set because there's a lot of discussion in the last 6 months or a year where you'll see headlines talking about the cooling labor market or the softening labor market. And two things can be true. It is softening relative to where it was in cooling. At the same time, it still remains quite healthy. It's really entered a period of stabilization. If we turn to then interest rates on top of the employment sector, this is where we've seen a little bit more of a struggle, right? It became really trendy that the phrase in 2021 and 2022 was higher for longer, that interest rates would last longer and that the Fed might struggle to get inflation back under wraps. Inflation has fallen, but we see a lot of rates remaining high. Our blue line here is the Fed funds rate. You'll see our forecast. This was made back in October. Since then, most revisions have moved downwards to about 50 basis point cuts, representing 2 cuts. Whether that all happen at once in a form of 150 cut or 2 different meetings throughout the year remains to be seen. Of course, inflation expectations and Fed fund rate expectations move dramatically. Anybody who followed it in 2024 saw that. So this is our expectations going into the year, but that could change. This blue line that has a nice steady downward slope, likely in its current moment, we would see a little bit of a plateau for likely the first half of the year before continuing on this decline. We'll get to the reasons why in just a second. But those of you who pay close attention to bond markets in the last couple of months will also realize that the green and orange lines are slightly out of date. And I actually intentionally included this for that reason. Both of them have since moved up 75 basis points. The 10-year Treasury is currently at 4.79 as of yesterday, and the 30-year fixed mortgages are around 7%. So both slightly higher. The point is, though, we expect the trajectory to largely continue on in the years ahead. We look at why rates have yields have spiked, excuse me, in the last couple of months. You can see here the 10-year term premium is really risen up in the last few months. And there's a couple of reasons why. I included on the right-hand side inflationary expectations. And so while there was a nice healthy downward trend in recent years of the next year ahead in terms of inflation, you can see at the very right a pretty strong uptick at the end of the year. So inflation's a part of it. Another big part of it is deficit spending and concerns that deficit spending is only likely to continue on in the years ahead. And then finally, we have, general uncertainty, geopolitical uncertainty. The effects of tariffs remain challenging to read even in its current moment. We'll talk a little bit about that moving forward. So if you're looking at what's going on in bond markets and why it's moving the way it is, there's a lot of different explanations. It's likely a confluence of events. These aren't mutually exclusive, rather they're reinforcing. The big question, I think, in the next month or two is whether this trend is going to continue, whether it's going to stabilize at a higher elevated point, or whether it's some short-term anxiety from investors that will be resolved with greater information, greater outlook over the next month or two. So that remains to be seen, but it's worth keeping your eye on. So 2 more slides on the overall macroeconomy, both related to debt. Turning back to the labor market and kind of the effects of having a strong labor market. When we look at household savings, we see that there was a massive spike, of course, in response to the pandemic. That's two factors that really influenced that. On the one hand, stimulus checks. They did increase savings for many Americans, especially those who don't have much savings to begin with. Those were really important. And then the other thing is behavioral changes, right? If you remember those first 6 months of the pandemic, nobody was traveling, renting hotels, for many people longer than 6 months, but at least for the first little bit, pretty much everyone had a decline in their economic engagement, but before activities sparked back up. And so that, along with the stimulus checks, increased savings. Americans, we ate into that really quickly, which is good for the overall economy and good for spending, good for the labor market that we didn't save too much, but we're currently at kind of long run averages of savings. And same with consumer debt service. So the debt from the consumer standpoint is pretty steady. The same cannot be said of the federal government. Federal debt continues to rise. We're up to $36 trillion, I believe, from my last check. Here we have 2 ways of measuring it, both as percent of GDP. One is debt service. So you can see at the orange line at the very end is really spiked over the last 6 months, the last year. It's not outside of historical ranges when interest rates were higher in the 80s and 90s, but it is growing relative to the last decade or so. And the blue line is what gets discussed a lot and is a point of discussion and will be for the next administration and frankly the administrations beyond that, which is overall debt as a percentage of GDP. It's up to 123%. And you can see that the largest increases have come during moments of crisis, so 2008, 2020. However, we've run deficits since 2001. That was the last time we ran a surplus. So across administrations, political parties, deficit spending has become the norm. And because of that, while responses to crises oftentimes necessarily involve some stimulus and funding, it's really that stabilization that we continue increasing, stabilize, continue increasing as a percent of GDP. The big question here is not that in the current moment it appears unmanageable or that it will seriously harm the US moving forward, but really what happens if another crisis strikes? What happens if it's geopolitical, economic? You can never really predict a crisis. That's part of the definition of having one in the first place, is that level of uncertainty and unexpectedness. So looking forward, that's, I would say, not looking like an issue for the federal government in its current moment, but in the years ahead could quickly become a serious issue and will remain a political issue in the years ahead. I have a couple slides on how the recent election might impact commercial real estate. And so there's, despite a lot of certainty gained from the election results and having knowledge of where we're going moving forward, there's a lot of uncertainty, as I'll cover in just a moment. So my first slide is a quick and fairly simple model that me and a couple of other economists on our team ran back in September and October. This was before the election. The reason I'm including it is I think it really highlights what we're expecting to be a high level of trade-offs. So with tariffs, with immigration, with overall economic policy shifting in the new administration, there's a lot of concern over what type of instability it could cause, or some strong optimism that this is where the growth America needs. I think what we're about to see over the next couple of years is a lot of trade-offs. So in our model, we included lower immigration levels and increased tariffs, depending on if it was a Republican sweep, Democrat sweep, and then in the middle for each of them with divided Congress. We ultimately, of course, got the Republican sweep. What our model suggests is that with a reduction in immigration and reduction on supply as it relates to housing, and this is a multifamily housing model, we expect rent growth across America to be lower than it would have been had Vice President Harris won. So in the world where President Trump has won, over the long run, we expect the lower demand to lead to lower rent growth. You'll notice a small increase initially there on the left-hand side, largely due to the more immediate effect of tariff policy in the year ahead. And then in the middle graph, you see that income growth as a downstream consequence of expected GDP growth being stronger in a Vice President Harris administration. That's once again due to a combination of both immigration policy and tariffs. However, when you combine them, it really signifies that trade-off, which is rent to income ratio. So how much of your income would a median household be spending on an average market rate unit? We expect that to more or less be the same across the two administrations, and really being driven by broader macroeconomic forces. Speaking of immigration, the U.S. Census released their 2024 vintage back in December, and Brookings produced some really excellent visuals. I highly recommend looking at this article if you're interested in migration patterns in America, not only in terms of international immigration, but domestic migration. You can see on the left-hand side, that's population growth state by state, with the South being the real winner. I don't think this is any secret. States like Texas, Arizona, Florida being big winners. North Carolina and South Carolina have in many ways flown under the radar in terms of their population growth. They're doing really well. We've seen, and we'll talk about in a bit, their multifamily growth in Raleigh-Durham in particular, Charleston, both really strong in those two states. And despite some states, especially in the Midwest, looking like their population growth isn't the most significant, if you compare it to a lot of like long run trends, it's actually pretty good. I'm from the state of Michigan originally. Detroit has had serious population growth issues ever since 2008 occurred. And so it's important to contextualize these things. California, for example, has really struggled. The right-hand side of the screen adds an extra bit of analysis on top of population growth by looking whether it's immigration from international immigration, or domestic migration, or natural increase, which would be birth rates. you can see Texas is kind of the big winner. It's growing in all three categories. Americans are moving there. New immigrants are arriving and staying there, and birth rates remain healthy. Whereas a state like California, it does have positive population growth, but that is because of international immigration, domestic migration. More Americans are leaving than arriving in the state. Two states that aren't necessarily included on the right-hand side, I mentioned them previously, North Carolina and South Carolina. Interestingly, they both actually have more domestic migration than immigration. They both have large amounts of immigrants coming, and so that's also this. If they were visualized here, would also be positive in the blue, but the yellow actually outweighs the immigration in those states. So looking ahead, North Carolina and South Carolina remain pretty attractive states for people to be moving to. So the final slide on effects of the new administration coming in, I looked at the CBO estimates. They ran estimates for tariff policy being implemented. They took 10% on all goods and 60%, particularly on China. They did not implement 25% on Canada and Mexico, as is being discussed. Their results, once again, highlight those trade-offs that are being made. It's not necessarily a good thing or a bad thing. It really depends on your perspective. It depends on where you think the redistribution of wealth will end up and whether that aligns with whatever normative interest you might have. At its core, they estimated that the tariffs would reduce deficits by $2.7 trillion over the next 10 years. So that's a long run trend. That includes what they expect in terms of retaliation moving forward. That this makes sense. Tariffs are revenue generating for the federal government. That's where the tariff money goes, so it logically follows that deficits would be reduced. 2.7 trillion is a pretty significant amount. On the flip side, over the next 2 years, so 2025 and 2026, they're expecting PCE to rise by 1%. This is really big when we're thinking about that battle for the Fed against inflation. If there's an uptick in inflation, especially an uptick in expectations of inflation, that can be really harmful. So a lot of uncertainty over how the Fed might approach this year, given the possibility of greater levels of inflation from tariffs. There's a final stat that I did not include in this visual, which is that 10 years on, so not accumulation of 10 years, but in 2034, they expect GDP to be 0.6% below where it otherwise would have been. So once again, that might be a worthwhile trade-off depending on one's perspective and where they think the U.S. should be in terms of geopolitical strategy and whether you view tariffs as part of national security and strategy, as the Trump administration is arguing. But trade-offs for tariffs are clear. It's not necessarily a positive or directly negative thing. It really just depends on which of these factors you think is going to be most important. So I want to turn to our space markets and look at our core four sectors: multifamily, office, industrial, and retail. Multifamily has gotten a lot of attention in recent years, especially with rent hikes. There's a lot of data on the screen. Don't worry too much about it. The real key things are the two top bullet points on your left-hand side. So we ended up with 6.1% vacancy to end the year in Q4 in our preliminary trends. Those are still being finalized. We're at 5.9% in Q3. So vacancy is ticking upwards, but we really think that this is due to short-term supply growth. Over the last 10 years, multifamily inventory growth has risen by 25.2%. There's been a lot made over recent inventory growth over 2023 and 2024 having near historic years in terms of deliveries. But this is a trend that started pre-pandemic. Part of the reason there was so much growth in the last couple of years is because people were ready for when the lower interest rate period immediately following the pandemic, before the inflationary period and higher interest rates for a while, investments were ready to be made. And so America's multifamily market has significantly expanded. At the same time, while inventory is expanding and driving the vacancy rate up, demand remains steady. That goes back to the labor market we were discussing. Wage growth remains healthy, unemployment remains low, household formation remains pretty solid. So for those reasons, the multifamily market remains fairly stable in terms of rent growth. A key aspect of America's housing market is we've heard a lot in the last year or two about America's housing crisis. But there's significant divergence occurring. The multifamily market, driven by that period of expansion, it has seen rents increase. This is nominal. So you can see that there's been a very steady growth with a short dip following the first impact of the pandemic in 2020, but more or less rents are fairly stable in terms of their growth rate in the multifamily sector. That is not the true for mortgage payments. Single family homeowners, and I'm sure this is no secret in this call, are really getting killed compared to multifamily. This is just mortgage payment. This does not include things like taxes or insurance or homeownership costs. And so reverse to historical trends where because so much more is included in apartment rent, that apartment rent is typically more expensive than a mortgage payment. That's no longer the case. Higher interest rates in the period of higher for longer is really driving up single family housing costs. If we look at divergence within the multifamily sector, we see that Class A properties continue to have elevated vacancies compared to Class B and C. This is due to the rent premium. That's the orange line there in terms of how much more you're going to be paying for one of those nicer, newer Class A properties, $500 to $800 usually, depending on which metro or which region you're talking about. Sometimes more depending on the metro. But there's demand and significant demand for older and most importantly cheaper buildings in the multifamily market. Now, of course, when we're talking about development, most of those are going to be Class A. It just pencils out more to have that rent premium on top of a slightly higher vacancy rate. An extra 2% or 3% in terms of units sitting empty can be justified when rent costs are that much more. At the same time, this is, I think, where some of the grievances towards developers sometimes come from. On the one hand, we all know that development helps lower housing costs in the long run. At the same time, when you listen to the discussions on multifamily housing and developing housing, that's where a lot of the NIMBYism comes in, is a slight resentment towards the type of units being built and whether people will be able to afford them. Although typically we expect that over the long run, developing even the nice, new, expensive units, there is demand for that, and people will fill those up, leaving cheaper properties slightly more open. So there's a trickle effect here. Moving down the housing ecosystem or the housing ladder from Class B and C into affordable, I'm just going to take a moment from multifamily and discuss that one of the interesting effects we've seen since the pandemic is that affordable rent growth isn't able to keep up with market rate Class B and C for all sorts of regulatory reasons. But this is also attractive then for consumers. If Class B and C properties have lower vacancy rate than Class A, the same is true with affordable housing units. In most metros, the vacancy rate is somewhere between 2 to 2.5%, and that's really just transitory. Most of the time, there's a wait list to get on affordable units. There's strong demand for affordable properties across America. On the left-hand side, you can see that demand is being met with inventory growth, especially in the Southwest, Texas, Arizona. Affordable remains a piece that is in demand for consumers, as well as and slightly more controversial depending on the developer and how comfortable they are with affordable overall. So moving into rent growth, this is a map that shows the last 2 years from Q3 in terms of rent growth. So this is outside of the heaviest period of inflation. If we look at the 5-year average, effective rents have climbed by about 20% nominally over 5 years. You can see that over the last 2 years, these rates are much lower compared to that national average of a 20% rent growth. There's not a direct correlation necessarily between inventory growth and rent growth and the immediate effect. You have to include some other variables. You do see in the South Atlantic, it has carried the largest inventory growth at 6.2%, leading to only 1.5% in terms of rent growth. But you have to add in other factors like population growth and wage growth and overall unemployment rates. If we look at the West, for example, inventory growth has been fairly low at 3.7%, but rent growth is only at 1.1% over those last 2 years. And that really gets to that lower demand with California. We talked about losing population. Lower demand is going to place pressure on the ability for rents to grow higher. Whenever we talk about rents, it's also important to situate them with something like income. So this is a map that shows rent to income ratios by state. The left-hand side is the nominal rent to income ratio. So that looks at if you're a household with the median household income in that state renting an average market rate unit, that's how much of your income you'd be spending on rent. And so you see that there's strong variation. New York, unsurprisingly, has the highest in the nation, driven by New York City. This, of course, makes sense. People spend more on housing in New York City, not only because it's crazy expensive, but because you have less costs in terms of things like transportation. But you see there's significant variation across the country regardless. A state like Florida and California are both really expensive. Texas actually isn't too bad. Whereas a state like Illinois is interesting because if you look at Chicago, it's much higher than the rest of the state. If you look on the right-hand side, this is some positive news. So much negative news is thrown at us, but thankfully in all states that we track, except for Kansas, the rent-to-income ratio has decreased over the last year, meaning that wage growth has outpaced rent growth. And this is being distributed fairly evenly across states. You can see that there is variation, but the fact that I believe we track 47 states, and 46 of the 47 have observed rent-to-income ratios falling over the last years is positive news for consumers who are reporting stress in terms of being able to afford the cost of living, especially with housing prices shooting up. So those who are renting are now doing better actually than they were pre-pandemic. I think that's an interesting stat. Rent-to-income ratios are down by about 1% compared to they were in Q4 2019. So if we turn from that positive news of affordability from a consumer standpoint into what effects it can have on real estate as a business, we see that effective revenue growth has been a little bit all over the place. And that's highlighted here on the right side visual. You can see that the shaded area between the global financial crisis in 2008 through 2020 was at a really healthy and steady state. That's what we're hoping to get back to. You see us using this term stabilization on the left-hand side, and that's the period we think we're in. Rent growth was fairly small this past year at 0.8% year over year. We expect that to get into about a healthy 2 to 3% in the years ahead. But you also see that effective revenue growth really spiked during the inflationary period at the same time. I'll draw your eye to the bottom left. Inflation is no secret. I think everyone knew that 2021 through 2023, we had that high inflationary period. I think it's useful to see it evidenced by this bar graph. So the lighter blue, that's 10 years. And then the darker blue is price increases in just 2 years. So you see that especially payroll, wages rapidly spiked, utilities, repairs, and of course, insurance. This has since stabilized. Those numbers are not growing at nearly the same rate, but you can see why effective revenue has been a little bit all over the place, in part because of operating costs really spiking. So effective revenue in Q3 2024 has improved. Thankfully, we see a lot of the major metros that, if we look year over year, have remained a pain point. Austin, Raleigh, Durham, Jacksonville, Minneapolis, and Charleston are now kind of turning positive in Q3. Many of these metros, I should note, are metros that are hot in the multifamily market. They've been points of focus for expansion. Many of them have expanded by 40 to 60% over the last 10 years in terms of their inventory growth. Keep in mind, nationally, that's at 25.2%. At the same time, that expansion has led there to be significant inventory growth, which has put pressure on their ability to see rent growth. And that is why effective revenue growth has remained lower. But as these apartments fill up and as they're able to raise rents slightly, then we're seeing effective revenue growth starting to turn. So my final slide on multifamily housing, I'll really focus on the middle and the right graph. The middle is interesting because we've had this massive expansion period, which has continued throughout 2024. We're expecting 2025 and 2026 to still have a significant amount of completions. The pipeline remains really strong. We're expecting that figure to decrease by about 15 to 20% from our 300,000 confirmed completions over this last year in 2024, strictly in multifamily. So 15 to 20% lower in 2025 and another 15 to 20% lower in 2026. But if you see this graph here in the middle, starts have really slowed down in 2024. They're well below completion levels. And so starting in later 26, really into 27 and 28, we're expecting a significant slowdown in deliveries. That is because of a combination of challenges in construction in terms of being able to afford wages or find available workers. But really, the story is interest rates. This is a result of the period of higher for longer. And it's also a result of there being that significant expansion period driven by low interest rates in 2020 and the first half of 2021. So as we discuss moving into this stabilization period, you can see that we're right here in our recent years and years ahead forecast. The vacancy rate is 6.1% in Q4. We're expecting that to likely either stay steady in Q1 or begin to decrease, hopefully pretty soon, return to historic averages. You can see it's usually at about 4.9%. Even if it remains above 4.9% due to the level of construction, it will hopefully steady out in the mid fives. Rent growth has been all over the place since the pandemic, negative in 2020 and 2023. You can see 21 and 2022 were both much higher in terms of rent growth. We expect that to normalize and steady out and towards the long run averages here, starting in 2025 and into 2026. Great. So moving from multifamily housing, I want to touch on the office market. This has been something that I'm sure all of us have read a lot about and heard a lot about in recent years. As of, excuse me, I need to update that from Q2. That should actually be Q4 2024. It's at 20.4%. It was at 20.1% in Q2 2024. So this time is different. That's a phrase economists love and sometimes get teased about, that we love to say this time is different, but really it is different. The reason is if you look at these historic peaks, 1986 followed a 6-year period of 8% inventory growth or greater. The 80s had a booming office market. Then 91, you have savings and loan crisis. You have the dot-com bubble driving things up in the early 2000s. And then, of course, 2008 and the Great Recession. So all of these previous peaks were either inventory growth or more commonly employment struggles and downturns in the market. As we discussed, labor market remains strong. GDP growth is healthy. Wage growth is healthy. This time is different because this is a permanent reduction in office utilization. There are big name companies calling workers back to the office. However, we're really seeing that hybrid models and remote models remain popular for many firms trying to compete for the best talent that they can. Being able to attract them with those offerings is strong. That allows them to then make a trade-off where you can rent less space, but really value the space that you do. So we're seeing that there's been a steady recovery. So you may have seen foot traffic data. Some people use swipe data to see that from 2020 was at its lowest, 2021 picked up, same throughout 22 and 2023. We're seeing that slow down. We might be getting close to a new equilibrium in terms of remote working styles, hybrid working styles that firms have now had 4 or 5 years to implement their models and for workers to adapt. We also see significant variation metro to metro. So Miami, people are still going into the office. There's a heavy foot traffic, same with New York City. Whereas Chicago or where I'm at in DC, that does not remain the case. Foot traffic data remains low and is starting to really slow down. Despite the overall bad news in the office sector, there are some winners. If you look on the left-hand side for occupied stock, Nashville is a really hot market. It's hot in many sectors, but office in particular. Atlanta is another one that has reported really good news throughout the year, at least relative to many other metros, maybe not overall positive, but relatively positive. And of course, Miami, as we just discussed, with heavy foot traffic. San Francisco is known as a market that's really struggled in the office sector. Tech markets in particular have struggled. In terms of vacancy rate, one that is not on the occupied stock bottom 10, but is on the vacancy rate bottom 10 is Austin. And that highlights how there is still development. Austin's vacancy rate is really increasing due to new buildings and new constructions being completed. Whereas San Francisco's is a fundamental shift towards using the offices less, and companies no longer leasing either at all and going fully remote, or reducing their footprint. At the same time, once again, some positive news. There's been a flight to quality. Class A buildings, whether they're in the suburbs or whether they're in downtown central business districts, are doing better relative to what they were in 2009. So this is indexed occupied stock. Older Class B and Class C buildings are struggling both in terms of suburbs and also downtown central business districts. Overall, we've seen that suburban vacancy rates have not risen to the same degree as downtown CBDs. Really, central business districts are struggling. If we look at any city, I'm sure many of you have, many cities are trying to approach and rethink how do you plan for the central business districts in the years ahead? For most cities, the level of utilization in downtown CBDs is just not going to recover. And so they each are trying to approach it either through attracting greater levels of multifamily and redevelopment and conversions, or moving to more of an events theme focused broadly. But flight quality exists, which is why we're still seeing not historic levels, or not even close to pre-pandemic levels of inventory growth, but we're still seeing a solid amount. I think we saw 17 million square feet in 2024. So turning to industrial is really the star of the pandemic. It's been the sector that has had benefited the most, not only from a lot of the, well, primarily because of their efforts to reshore and nearshore after supply chain disruptions caused by the pandemic, right? This has kind of been a long-term bipartisan movement, especially from voters, to re-emphasize America's industrial base. We've seen that translate into commercial real estate in terms of the vacancy rates. We've seen since 2022 in both flex and R&D and warehouse and distribution, vacancy rates tick upwards. However, these are both significantly below their pre-pandemic levels. Overall, industrial was around 10% vacancy rate. Now, depending on the sector, we're still around 4 to 5%. Effective rent growth has also stalled. A lot of the leasing that took place in 21 and 22 has really slowed down. Expansion has continued. Inventory growth remains pretty healthy in both of these subsectors. And so that is why effective rents are slowing and vacancy rates are ticking up. However, I would once again say this is similar to multifamily, where it's entering a period of stabilization. It's not necessarily negative news, but the red hot industrial sector has cooled into a much more stable long run view. This graph does a really good job of highlighting just how wild those swings were. If you look at pre-pandemic compared to what happened in 2022 in particular, we see that things are kind of leveling off, but even towards the end of 2024, we're kind of back towards a fairly neutral rate in terms of excessive demand and excessive supply. Turning to our final sector of retail, retail is a really interesting one because a couple decades ago, it was being discussed similar to how office was now. I remember my first job out of high school. I was working at Best Buy, and everyone was convinced we were going to lose our job any day, that retail was doomed, that everyone was going to shop online and Amazon was going to take over. Of course, that same Best Buy is still there. It's still working, and people are still going. That's not to say there's no pain points in retail, but rather companies have figured out how to embrace e-commerce in terms of attracting people in store and offering those experiences. And a lot of people still like that activity of getting out and having that physical relationship with whatever they're buying. If we look at the vacancy rate here, it's very flat annually, especially for this is neighborhood and community shopping centers. Malls are really where a lot of the pain is, especially for anchor tenants in malls. So retail has really gone through an evolution to a more mixed use and a greater focus on smaller, more efficient properties. But overall, retail is in a pretty healthy state compared to what we expected 10 or 20 years ago. final graphs that kind of combine the retail and industrial arguments. On the left-hand side, you have e-commerce as retail sales. Really spiked during the pandemic, but it obviously started before that and has continued onwards. We just hit a record high in the last quarter in terms of e-commerce as a percent of retail sales. And then on the right-hand side, we have construction spending in terms of manufacturing, once again, remaining high and elevated. And so there's tailwinds for both retail and industrial through e-commerce being embraced. So I have just a couple more slides. I want to keep the capital markets fairly short. What we're seeing for institutional property types is that while there has been a lot of instability and a lot of uncertainty in recent years, 2024 was at least upwards. Doesn't necessarily mean that returns are back to pre-pandemic levels, but across almost every property type, things moved in the right direction over the last year. However, when we look at things through CMBS payoff rates, we see a much more significant gap across sector types. Offices in particular are struggling to see payoffs on time. Extensions are continuing to happen. We see that malls are also struggling. So if you see, we have malls separated from retail, and that's really highlighting that gap we were talking about between kind of newer, more sleeker and evolved smaller retail versus the older, larger malls that people aren't going to as much. I will say, I think that might be changing, that some malls have been able to revitalize and seem to be doing quite well. But as a whole, the property type, it remains, it continues to struggle. And if we look at the year ahead, we see that there is a continued wall of maturities in CMBS. 2025 is set up to be another big year. 2024 was a big year, and moving forward into 2025, a lot of this will probably be pushed back as it has been into 2026. But paying attention to, in particular, this office sector remains important. We are hopefully nearing the bottom, especially for office, both in terms of vacancy rates and in terms of the capital market side. Now that we've had a couple of years to get a sense of the situation, we're getting the sense that things are nearing its bottom point, or may have already hit its bottom point. It's always hard to know, but hopefully we're getting pretty close. And that's all I have. Thanks a lot for having me.
Nick, thanks so much. And hopefully good outlooks, right? Overall, one of the things that I know we kept on talking about was inverse yield curve, right? We kind of had it a while ago, maybe 2 or 3 years ago, and now it recently kind of flipped again. And usually they always say that it is an indicator of a recession, but the strong current job market and other indicators seem like it's balanced. So what is your thoughts, or Moody's thoughts, on kind of that inverse yield curve kind of predicting a recession, whether it's 6 months or a year in that time frame?
Yeah, I mean, I will say my expectation is a lot of that stems from uncertainty. And so, on the one hand, it felt like the election was going to provide a lot of certainty in terms of knowing the direction ahead. I think the last 2 months have shown that, especially as it relates to tariffs and the eventual tariff policy that is implemented, retaliation, and the road ahead, I think a lot of that is temporary uncertainty over what's going to be happening. And so that's my answer. I think it's, recession indicators are always, you can always find them if you want them. But at the same time, with the labor market remaining so strong, with Friday's job report, I have a little bit of skepticism thinking that we're going to be heading into the recession in the next 6 months, unless things really get wonky, I think, with tariffs, because we're moving into a space where that really gets into the international politics side of things. The U.S., we have not solidified a tariff policy domestically yet with the new administration coming in. Even when the United States formalizes its tariff policy, we then have to look towards how other countries are going to respond. And so I think that level of uncertainty is creating some instability.
Thank you, Nick. Is there any questions from our audience right now? Anyone have any burning questions, or otherwise I'll ask another? So Nick, while they're thinking about it, back in, I would say, what is it, 2021 or 22, we did have 2 negative quarters of contracting GDP. And normally that's an indicator that we're in a recession. Did they just reclassify what it was? So you know what I mean? If you speak or talk about it loud enough, it's a self-fulfilling prophecy saying we're in a recession. We become and go into a recession. But if we just say we reclassified, we're fine, and we actually went through a recession, and now, you know, everything is okay besides tariff and new policies. So what is your thoughts on kind of reclassifying what a recessionary period was?
Yeah, I think the definition of a recession is one of those tricky things. I could be mistaken, but I think part of that was that initially the report wasn't it that it was positive and then it was revised to being negative. So we were in a period of recession. I could be mistaken on that. But I firmly agree that expectations play a understated role. I think oftentimes when we discuss economics and oftentimes we look towards numbers to guide us, but a lot of it is mood and sense. And if you think that things are about to hit doom and gloom, investors and in the business community will lead to that being okay. At the same time, you can also do the inverse. You can also fool yourself into thinking everything's healthy and fine. I'd say that's the story of 2008, right? Is the signs were there, the cracks were there, and that most people, of course, there were some who predicted things accurately, thought things were more stable than they necessarily were. Yeah, I would say that the definition of recession is always questionable, right? If you have a serious period of economic downturn, but it doesn't last 2 quarters, it's not a recession versus you could have negative 0.1% GDP growth and that would be considered one. I think a lot of times we do overfocus on that that definition of a recession.
Thank you. Any questions from anyone? Or I'll keep asking questions for a bit because I have a lot. I'm curious. And you know, we've been always talking about, and I'm glad you know, with retail and office stabilization of product types, but the one that everyone's concerning is our debt and getting our debt under control. It's just getting that our servicing of our debt is now, I would, what $1 trillion or something, it just, or a couple $billion. So it is so high, it's almost as large as our military cost per year. What do you think, and how is this? And we've had different meetings of, we're going to inflate our way out of it, right? And then refinance it when we drop the rates, a little gamesmanship, right, of adjusting interest rate. What are your thoughts about how do we tackle and get you know, our federal debt under control?
Yeah, no, I think you're exactly right that there's this hope that we'll grow our way out of it, whether it's through kind of inflationary growth in terms of nominal value or just in the long run, everything will be okay. In the long run, we'll all be dead, of course. But yeah, I don't know exactly how I feel to answer that question. I guess I'll start with saying I'm a massive skeptic that that's going to happen anytime soon. I think if you look at the state of Congress in terms of trying to get spending through in the first place, I don't think we're going to seriously tackle things like Social Security or healthcare costs. I don't really see there being a large appetite for tax increases. I think that we'll likely see an extension of the tax cuts that are expiring over 2025, right? There could be a big battle. There are, of course, always some deficit hawks in Congress who make a big stink of things as necessary, and that's not necessarily a bad thing. At the same time, if we haven't changed in the last 23 or 24 years from our deficit spending, I didn't hear much about it in either any of the presidential debates. I don't really see many Congress people able to stake their careers on tackling deficit spending. And so for that reason, I think it's very likely at least the next 2, if not 4 years, even beyond that. I think this is the sort of thing where debt would have to become a crisis in and of itself in order for the American population to put enough pressure in order for us to tackle debt. But of course, if we do have an economic crisis caused by our debt service levels growing high or concerns about the debt, then negative economic downturn will likely be met through spending. And so, yeah, I don't think it's necessarily a good road forward in terms of debt. At the same time, I don't think there's an immediate threat when we look at spending levels. We GDP growth remains strong, and income for the federal government remains pretty strong because of that. And so I don't see it as an issue right now, which is why we keep kicking the can down the road. But if we keep kicking the can down the road, eventually the bill's going to come due. Yeah.
And now kind of going to the personal, since we know 2/3 of our economy is run by personal spending. And our consumer debt is at the highest we've ever seen and defaults are rising. When is that tipping point, or is President Trump coming in elected going to cap, right, the interest rates that we can charge on credit cards? What's your thoughts on, consumer debt right now being at the all-time high, and now that we're starting to see delinquency starting to pick up because of all the costs of just living for most Americans?
Yeah, consumer debt's interesting because we know it was high prior to 2008, which is part of the reason why that recession got so bad, is that people were already indebted. And so when the labor market got tough, it was hard to pay for not only housing, but other expenses like credit cards. I unfortunately have to once again just agree with your pessimism and say that I think higher levels of debt for American consumers has become the norm. It's become kind of expected. It's part of our everyday lives in terms of embracing credit cards, and the number of Americans and the level that credit card debt is high. There's, of course, another form of debt we haven't talked too much about, but it's student debt. It got a lot of attention a year or two ago and has completely fallen off the radar. The issues that surround student debt in terms of tuition costs, they're still there. Nothing has really changed significantly on that. And so I think we like our debt. Right? There's economic literature that argues that the root cause of all crises is debt. Reinhardt and Rogoff, I believe, R&R. And so if you are a believer in their argument, then we're headed down a bad path with pretty much every aspect of our economy having debt. At the same time, I'm not sensing much change coming from consumers in terms of their willingness to spend. And of course, if consumers did start to manage their own debt levels in appropriate ways, we would see negative consequences in terms of GDP growth and downstream wage growth. And so you have all sorts of negative prospects of people tackling it seriously. So I don't see there being much motivation from a policy standpoint in terms of trying to correct that behavior, because the short-term consequences would be negative for whoever's in charge at the time.
And final words, what you see, and I know within the snapshot, because everyone's waiting week to week to see earnings and forecasts and reports. What do you currently see for 2025? Just some items that you would say for us to be aware of and what to look out for.
Yeah, I think well, there's a lot. First of all, is tariffs, not only wherever the U.S. settles, but I'm really interested in that international response. There's been a move in recent weeks for the Trump administration and those appointed to associate the tariff policy with security. And so whenever that happens, it changes the game, right? Because it's no longer just about the economics of it and the retaliation there, but there's arguments then that in order to be part of America's security umbrella, that unilateral tariffs need to be allowed, or that retaliatory should be lower and managed. So geopolitically, I think tariffs are the name of the game. Of course, things like how America is going to approach the Iceland, or President Trump's views on Canada and Mexico are worth paying attention to. They've moved from, I think, sometimes when people saw them at the start, maybe thinking he was just being silly on Truth Social, to realizing that these actually could be geopolitical movers. I think that it's time to take those discussions more seriously. And in the year ahead, I look at it and there's a lot of geopolitical uncertainty. There's so many risk factors that it's almost impossible to really discuss them. And yet I will also say that those risk factors have existed in recent years, and economic growth has remained fairly steady and robust. The labor market remains strong. And so despite a lot of anxiety and a lot of points that could cause a crisis that could then impact the U.S. economy, so far we remain resilient, and it appears likely to me that that continues throughout 2025. Of course, nobody expects a crisis, so I could be totally wrong. I wouldn't want to suggest that everything's going to be healthy and fine. Risk factors definitely exist domestically and internationally. But betting against the American economy has not been a wise bet in recent years.
Thank you, Nick. And I know there's one question from Blair Gilbert out in Pennsylvania. Because of the wildfires and let's say natural disasters and how is that going to affect because of the amount of obviously destruction in Southern California?
Yeah, absolutely. So we're working on some reports right now to try and estimate that. One thing that's interesting is so far, the wildfires have primarily affected single family homes. And so there's going to be stress and demand in California, especially in LA, on rental properties. You're seeing a little bit of price gouging start on websites like Zillow. But in terms of multifamily, we haven't seen the wildfires directly affect as many apartment buildings compared to single family homes. But of course, that displacement is going to have downstream consequences for the local economy in LA. At the same time, then, when the fires are managed and the rebuilding starts, there's going to be greater demand on construction materials and in terms of labor. So a lot of change about to happen in the LA area. I don't have exact figures in order to tell you how we're expecting it to play out in the housing market, but it's of course horrible and tragic and pretty serious in terms of its scope and size.
Thank you, Nick. And thank you, Nick and Moody's, for giving us this update, letting us ask a couple questions, getting your insight. We look forward probably at the half of the year to invite you back and see where we're at. So again, thank you so much. And thank you, Moody's. And everyone, please join Top Agent Nation Commercial Wednesdays, where we really are trying to share and show great ideas, cutting edge concepts. But if there is something or a speaker you would like to hear or a topic or technology, please reach out to us and let us know what is of interest so we can take a look at it and get a great speaker like Nick from Moody's. So again, thank you so much and Happy New Year. Let's make 2025 a great year. Thank you so much, everyone. Have a great day.
Thank you.